let's look at some of these ratios. Okay, here's earnings per share, EPS. Here's PE ratio. So you'll note it's around 10, which is pretty low by most standards. Here's the dividend yield. So this would be this divided by this. So here's the dividend in dollars that they're paying per year. This is how much you're paying in order to get this $4.24 a year today. That's how much you're paying today. So this is the yield today. Tomorrow, when the price goes up, if the price goes up, then the yield would go down. So as long as the dividend doesn't get cut, if you buy it today, this yield gets locked in. And then if the dividend goes up because it's a ratio, then your yield on the money that you invested, your $76, would actually keep rising. Obviously, the opposite happens if the company does poorly. This is the payout ratio, so 56%. So that would be their earnings per share divided, other way around. Dividend for $4 divided by 751 is roughly 56%, I guess. So it basically shows, are they able to cover the dividend that they're paying? And it looks like they are. I wonder which quarters are included in this. Usually they put this as just going a year back. So if if quarter 1 is included, then I guess that's a fair representation. Market capitalization, so Bank of Montreal, and by the way, I don't own Bank of Montreal, nor am I advocating it. So here's how much the company is worth. That would be the shares outstanding here times the 76 bucks per share that multiplies out to this. Here and of course your brokerage will be differently spaced out. There should be similar information, however. So what I like to look at is also.
Hey, Alesh.
Yeah.
A quick question, because I see it often and it's kind of in the main page, and explain it as you will, but what exactly is the beta? Like, I've kind of read a definition of it, but I'm curious if you have any thoughts on this. It's always in the main page too, right? It's like it's variance, I guess?
Yeah, it's the variance away from the index, I want to say.
Yeah, it is.
Yeah, okay. It's not one of my key metrics, frankly. The beta will be larger if the company is smaller because they'll have more variance.
Oh, well, it's a measure of volatility. Have you guys heard about an index called VIX? So VIX is pretty much the same as beta, but VIX is usually given to indexes. So you're comparing individual stocks, a price volatility of individual stocks to the volatility of the whole index that you're comparing it to. For example, if you have Microsoft from S&P 500 and then you're comparing its volatility to the S&P 500, the whole index where it comes from, that actually gives you a beta. For example, if your Microsoft has a beta of 0.5, that means its price volatility is about 49% lower or 50% lower than the stock index. So using stock index's volatility as a baseline 100%, if your stock is 0.5, that means it has 50% less price volatility compared to the stock index. So usually if you look at stocks such as defensives, they tend to have such as utilities and consumer staples like Walmart. They tend to have less price volatility, so you would see that their beta is significantly lower like 0.35, 4, 0.4. Does that answer your question?
I think so, yeah. So if it was a solid 1, it would be saying, it would be tracking against its index, like
Yeah,
its own, whatever the BMO would be sitting on,
yeah.
TSX, I guess. Let's pretend. I'm not
Yeah.
too sure what the main one is. But yeah, 1 would mean it followed it exactly as an index. Okay,
That's right.
cool,
Yeah.
thank you.
The Canadian banks are quite large as well, so they probably are a hefty share of the index as well. So that will also sort of align them with the index to some degree. Um, what else did we have? So in fundamentals, um, yeah. So if volatility matters to you, then you would want to look at that. I'm okay with it.
Yeah, can I make one additional comment for Azala? So if you're really interested in looking at companies with low volatility, nowadays the companies that produce ETF financial products, they come up with low vol ETFs. So they would actually choose stocks that have low volatility compared to their stock indices, and they would put them together in an ETF. So for example, if you look at S&P 500 low vol ETF, so they would look at out of 500 companies, the ones that have lowest volatility in that group, and they would put them together. So if that's something, if you want to be very defensive in your investments, it's a good product to be into.
Thank you.
Or you can look at their prospectus for those ETFs, and they'll usually show you the top 10 holdings. So then you can use that as your starting point for analysis if that's what you're looking for. I seem to remember a couple of different studies that said that low volatility companies actually outperform uh, higher volatility companies. Um, Anyway, that was just a study that I read. I personally don't mind the volatility, and if something drops, then and I still believe in it, I'll buy more. So I actually take advantage of the volatility. But for a lot of people, it's heart wrenching. So it, as in the previous seminars, you have to kind of know what sort of volatility and risk you're comfortable with.
Yeah, the problem with volatility, it kind of changes with each economic cycle, Alex. It's now what used to be a very defensive low vol utility stocks, they're not that defensive anymore. So what technology has actually in healthcare has emerged as a very defensive sector, which is quite weird, right? So with each economic cycle, the trends and patterns of defensiveness towards stocks are changing. So and that's what they do in this ETF. So right now you would see that those low vol ETFs used to have utilities and defensives and consumer staples. Now they have high weight of technology and healthcare because these sectors have emerged as defensive sectors now. So it's quite weird.
And so the takeaway from that would also be that if you do buy individual stocks, you have to keep an eye out on them, and you have to keep an eye out on the trends in the market, and you might have to rotate out of things and into things. So then buying the index if you're not into looking at the news all the time and analyzing these things, that's again what I'll point you to. So, all right. So yeah, good point, good discussion. One of the other things. So here's the debt to equity for this bank. So definitely under 1. So that would meet the criteria. The current ratio, however, I'm a little surprised that it's under 1. I don't think BMO is going to go out of business anytime soon, but it's a little strange. Like I would have expected it to be at least above 1. And like I said, usually you try to aim for 2, a multiple of 2. What is good with um, what is good here is that they grow their dividend, which is one of the things you want to look for. So they're growing it at over 5 years, they're growing it at almost 6% per year, and over 3 years, they're growing it over 6% a year. I wouldn't expect them to keep doing that with the current market environment and COVID and all that, but at least they're not cutting it. So now here's this was long-term debt to equity. Here you have total debt to equity, so that includes the short-term debt. So that's a little bit higher. So that you're kind of thinking, yeah, okay.
Yeah, it's very common for financials, Alec, to have a really high debt to equity ratio.
Yeah, I don't. Yeah, not all of them. I bet you I could look in one of the other
Uh,
ones, not to be that high. Anyway, I don't own BMO. It's not because of that or anything like that. PE we talked about, price to book is 136, so that sort of seems to be in line with financials. Here's that return on equity. So this is the management effectiveness. It's how well are they using the assets and to turn a profit. So 12 isn't great. It's not horrible, but it's not great. I think we sort of covered all the major ratios. Any questions before I flip back to the presentation? The calculations you can always look up. It's how to interpret them that's sort of important that I'm trying to pass on to everybody.
Yep.
Girish, any other ones that you sort of use to analyze?
Yeah, I mean, you did a really good job, Alec. I mean, this is a really nice introduction. Thank you. I think
Thank you.
everybody, and the structure of the presentation was quite nice. No, seriously. But there's one thing that I would point out, and which Alex has actually kind of talked about it a little bit, is the difference between income statement and cash flow statement, right? When you're looking at income statement, the metric that everybody looks at it, net income, which is net earnings per share, and what that factors in is the depreciation of tangible assets and amortization of intangible assets. So those two, so you basically, whatever the assets that the company has, they depreciate over time at a certain rate and they have a residual value, right? So that depreciation is not a cash transaction, but according to GAAP, right, they have to report it. But it's not a cash transaction. So what cash flow statement tell you is that since this is not a cash transaction, we're going to add it back to net income. So what really matters as an investor is how much cash does the business produce, net cash, which is free cash flow. So I and many investors tend to agree with that, including Warren Buffett and all of those hedge fund guys, is that how much free cash flow that the company generates and how stable and adequate is that free cash flow. So free cash flow, what I'm trying to say is a better metric over earnings, looking at how much investors can benefit from a certain investment, right? And I think Alec already kind of talked about that a little bit. I kind of wanted to point that out one more time. uh, and free cash flow comes after paying everything, right? Capex, interest rates, taxes, uh, everything literally. So it's really the amount of free cash that the company has in hand, and they can decide what they want to do with it. They can choose to distribute it among shareholders, a fraction of it they can use it for share buybacks, and the rest of it they can actually reinvest it back into the company to grow their assets and free cash flow in the future. So kind of wanted to stress that metric a little bit more so that everybody gets how important is it.
Yeah, exactly. Yeah, thank you. So free cash flow is something a lot of people use. And then they look at it into the future, and they look at future cash flows as well that they can expect from the company. So if you see a company that's using most of its cash flow to pay dividends, and they don't have any money to invest back into the company for increased efficiency and new technology, then you might be thinking, okay, this company, like the days are numbered, like they're either going to have to cut the dividend, which will hurt the share price, or they'll eventually lose their competitive edge. So it's something to look at. Um, yeah, absolutely. So the other things I look at, and I'll mention it in the future, so in another part of the presentation, is you're looking at the top line, which is basically your revenues and income, and you're looking down here at the net income. So what you sort of want from both of them is for them to be increasing, if at all possible. So 2016, 14 million, 2017, 15.8, 19.4, 26. So yeah, definitely increasing for interest income. I would say it's increasing quite nicely for such a big institution, actually. And let's see what happens down here. So for net income, 4.6, 5.3, 5.4, 5.7. So the bottom line is also growing. So this means that the company is making more money, and by having higher earnings, the PE ratio is going to stay the same even if the price increases, right, as that proportion. So that means without anybody thinking the company's overpriced, their share price can go up because they're having higher earnings on the bottom line. So that bodes well for the company. Now you'll have companies that are just starting out, and we'll get into that, I think, on the slide that's coming up. And the earnings, forget the word interest, that this is a bank, but just whatever the company does, you'll have earnings just skyrocketing, but they're not making any money. So they might actually be having losses down here. So that's a sort of a startup company, and you can decide to invest in them or not. That's up to you. So that was sort of a segue. So growth stocks, and if you look at mutual funds, you see this little 9 square grid, and on one axis is value and growth. So that's sort of what they're investing into, either growth or value or both. So concentrating on growth, those are companies that are expanding, they're hiring, they're likely new. The sales are increasing at an increasing rate. Earnings, if they actually have positive earnings, are growing, and it will have a high PE because a lot of the price is future earnings that are being built into that high price. So think of, Tesla. Oh my God, they don't even have a profit at this point, but they have a huge price. So it could be expensive, but it's getting more expensive. So it has a high PE, but it keeps going up based on future expectations. Ideally, if the earnings are growing faster than its industry or the overall market, that would make it a desirable company. Profits, if any, are being reinvested into the company, and they'll hardly ever pay dividends, hardly ever, because they don't have any money that they want to pay back to the shareholders. But of course, they're still building value with the higher share price. So, if you sell a part of your holdings in that stock, you still make money. And I said this before, price has a built-in expectations of higher future earnings, and it may not be profitable today. In fact, a lot of startups aren't. They're just sort of living off their capital, and they're bleeding cash. So their investors put money in, and they're not really expecting any return for 5 years while the company gets up and running. Obviously, that's also when the company's vulnerable. Value is sort of the opposite. You can make a case for it. it'll be cheap using the price to book, or under the intrinsic value. Intrinsic value being sort of what the summation of the assets minus liabilities plus future cash flows plus dividends and so on. That's its intrinsic value. So if the current stock price is underneath that intrinsic value, it'll have a low price to book. Another definition of a value company is that pays dividends. So I mean, you can have a growth company that pays dividends. As I said, it's not frequent, but that can happen. So it trades at less than its fair value or intrinsic value. Every analyst will have their own idea of what that fair value is. It's highly guesstimated. And then a lot of mutual funds will claim that they're using growth at a reasonable price, or GARP, which is that blend. So it's a center square in that mutual fund 9-square grid. They'll combine tenets of both. They will look for companies that are showing consistent earnings growth above the general market, but they'll also exclude companies that are overvalued. And again, it's everybody's perception, everybody's opinion. All right, what time do we have here? So we're past 8 o'clock. Shall I keep going? Is everybody still okay? Give it another 15-20 minutes, or should we kind of cut it off here? Me.
Yeah, I'd like to hear strategies and suggestions.
All right. Well, there's about 5 slides of this, but all right. Well, let's keep going. I should have put page numbers on this because I have no idea how far along I am. Got to quote Warren. I call him Uncle Warren. Be fearful when others are greedy, greedy when others are fearful. This is basically going against the grain. It's scary, but that's when you make money and you avoid losses. So this is very important. Determine your approach before you buy a stock. You do all your analysis, you do all your reading, you listen to all the experts. For each purchase, decide whether you're investing or whether you're trading. Now, when I say trading, I don't mean day trading. I mean, are you holding the stock for the long run, or are you looking for something to happen and then you're going to get out? So I'll explain each of them. So investing means long term, and then your strategy goes, if it goes down, buy more as long as you believe the reason that you bought it for initially are still in place. Because it's now on sale, it went down. If it goes up, you can start selling once it passes the fair value, whichever fair value you decide to believe. Some people will sell a third after it goes up 100%. They'll sell another third after another 100%. So now it's twice the value. So you got your money out. Now you're sort of playing with the house's money. Single stocks will have large moves, especially small stocks. So this isn't really out of the ordinary, but what goes up at a nice rate can also go down at a nice rate. And if it has a bad quarter, it'll drop 20% in one day. So anyways, so that's kind of the strategy for investing. That's fairly easy. Now, if you decide it's a trade, now you usually do it if you're waiting for something to happen. So it's generally short term. It's not the 1 day thing. It's not day trading. It's not even 1 week. It could be 6 months, but it's not something you're going to hold for 20 years. So you're waiting for something to happen. Usually, you heard a rumor the company's going to get bought. You're expecting a pipeline to get approved. And as soon as it does, the stock in 1 day will jump up 10%. Boom, you're out. That's it. So the general strategy here is as soon as whatever happened, or whatever you're expecting to happen, you get out. If it goes down 20%, this is sort of a general number. Have something called a limit order in place, or something called a trailing limit order, which I'll explain later on. Have those in place to minimize your losses. I'm gonna repeat this multiple times. Don't stick with losers. You have to be dispassionate about it. I'll repeat that multiple times throughout the presentation because that's where everybody screws themselves up. So if whatever you're waiting for didn't happen and doesn't look like it's going to happen, get out. Cut your losses. Say, my bad. If it goes up, start selling. Again, you could sell your whole position. It depends on why you got in the first place. Nobody's ever lost money taking profits. This is a fairly common saying on any trading floor. And so you might want to be out by the time it doubles. Never, ever, ever, never, ever turn a trade into an investment. Don't watch something go down and say, I'll bet it'll go up. And you double down and you put more money into it. Just admit defeat. Be dispassionate about it. Leave those trailing limits and automatic sell orders in, and just be dispassionate about it. Don't take it as a personal, hit to your ego. Our need to be right causes us to double down and put more money into a loser. Just know which side you're taking on these investments, and know when to get out. Diversify. I think this goes without saying. Own different sectors, and maybe using ETFs. You can own different parts of the world. The world communicates a lot, and a lot of bigger companies are multinational, so diversification is maybe not quite as frequent and easy as it used to be. So for each stock, have a story. Be able to explain in simple terms to a friend or coworker, or some people say a 10-year-old child, why this is a good investment. Buy stuff that you know, ideally. I'm guilty of buying stuff that I'm like, I'm not quite sure how they work. Stock price drivers. So earnings a company makes and is expected to make are kind of the main driver. The cash flows, but basically it's about the profits. A company that doesn't make a profit is a bit of a speculation. And some would argue, and I would count as those, is that if it doesn't pay you a dividend, that it's a bit of a speculation. You're depending on other people to bring up the price in order to make money. So so anyway, you need earnings. The quarterly reports, there's when companies report once a quarter. Beforehand, analysts will give estimates and set the expectations. The market sort of takes those expectations in, sets its price there. When the company reports, if it beats the estimates and the expectations, stocks will generally go up, not always. If a company loses money or is below the expectations, the stock price will likely go down. Obviously the company's trying to do better than the expectations. They seem to try to manage them to be fairly low. So it seems about 75% of companies seem to beat the expectations every quarter. So some argue the analysts pull those expectations out of the air. So anyways. Also, another stock price driver is how the company distributes its earnings to shareholders in dividends. Dividends in North America are expected to be constant and or increasing. In Europe and in other places, a company will sometimes pay a dividend, sometimes not, and nobody seems to care. In North America, I guess people are living off of them, and so they need constant dividends, and they prefer them to be growing. And then, of course, you have various macro events that affect all the companies. So Russia invades the Ukraine, market sells off. Doesn't mean that your company's bad. It just means there's a macro event where people are fearful and they want their money. Obviously, the overall economy, when everything's chugging along, you're doing quite well. So is the stock market. The stock market is forward-looking, however, and so the stock market will go down expecting a recession. A recession will happen, and before a recession finishes, the stock market's already gone back up because it's always trying to look forward. It's not always accurate, and sometimes the market panics. Sometimes it's overly optimistic, and so there's always opportunities. You probably know this already. Smaller companies are more volatile, both up and down. Everybody's okay with it being up, volatile, but doesn't like the down. So best approach, again, buy an index. Don't try to beat the market, but that's why we're here. Even experts can't do it consistently. With stocks, you're basically building yourself a portfolio that looks like a mutual fund. You have zero MER once you paid the commissioner to buy the stock. You don't pay anything, but it's not professionally managed. So just something to think about, because I look at my portfolio and it's like I have 40 stocks. I built myself a mutual fund, and sometimes I think I'd rather pay somebody 1% to manage it for me. So just a thought.